G'day listeners and welcome to another APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market and everything that's happening in real time. Now guys, story number one, the drastic changes needed for Australian rents to fall below their peaks. Now, there's an interesting article to dissect, guys, because a few clients and even a few of the staff at APS were asking me the same sort of question. What happens when a market comes off the boil or peaks out? Do the rents fall back to like long-term averages or do they stay where they are in the new markets? So thankfully, we've got the lovely Sue Williams. We've got an article from her from over at Domain. Australian rentals will be out of luck if they are hoping for cheaper rents, as experts forecast they will not return to lower levels despite a recent slowdown in growth. It would take dramatic interest rate cuts, a massive number of new homes to be built, and a smaller population for their asking rents to fall below their records, experts say. The combined capital median house rent remained at its high of $650 a week in the September quarter, but that's up from $430 a week from 5 years ago. Units also remained at their peak of $630 a week in the latest quarter, but up from $450 a week since September 2019. So over $200 a week increase on both of those in a 5-year window. House rents are now sky high in Sydney at $775 a week. Perth is at $660, Brisbane at $625, Melbourne at $580, with units not that far behind. PRD chief economist Dr. Diaswalti Mardismio said that while some regional rents and capital cities suburbs were stabilising and others dropping up to 10%, rental markets would not decline any further. But the expectation that they'll more widely drop back or that they'll even fall further to what some people are wishing for, which is back to COVID levels or pre-COVID levels, is quite unrealistic, Mr. Mardismio says. That would be a massive drop as they've risen so much in the last 5 years, it would have been impossible for landlords to go back to that level, primarily because they're now facing much higher interest rates for those mortgage repayments and higher still for investor loans rather than those for owner-occupiers, noting that other holding costs such as council rates and insurances have also risen in the same time. Now, I don't know about you, but for any of your properties out there, I know a lot of my council rates and insurances have almost doubled in that time frame in the last 4 to 5 years. Now, that obviously is inflation, guys, pushing a lot of these things up to a pretty high level. Mardismio said that many landlords increase rents as a result to hold onto their investment properties, and even a rate cut of 25 basis points would have little effect in the short term, with tenants often on one-year leases. Centre for Independent Studies chief economist Dr. Peter Chulip said a huge surge of new properties would be needed for a substantial decline in asking rents. Now, this is a key one, guys. We'd have to build a lot of housing for that to happen, hundreds of thousands of new houses or even millions of dwellings for this to play out. That would have to be a policy choice, and as a society, we would have to decide whether we want housing to be affordable, and for that to happen, we need to accept higher density in our inner suburbs. If we continue our endless suburban sprawl, rents will keep increasing. BIS Oxford Economics Head of Macroeconomic Forecasting, Sean Langcake, said any boost in the housing supply in Australia would still need to surpass population growth to make any real difference. Langcake said that current population growth hovered around 0.9% a year, which is a big figure for housing to equal, let alone exceed. Other factors that could temper demand, like young people moving back in with parents or choosing share housing, would only constitute a drop in the ocean of a solution. The worst outcome is that rents would drop because the whole market and economy is declining, Langcake said, which wouldn't be a positive story at all for anyone. It's more likely that the odd market comes off, but generally demand remains high with steady population growth. While government housing targets feel very aspirational, it's hard to see rents falling back in a very big way. I think it's more a question of how quickly are they going to go up rather than when they are going to go down. Now, I know that was a bit of a lengthy one, guys, but I wanted to include the different sort of points from different people there because I think they were all relevant. But in summary, look, this always comes down to supply and demand, right? We've got to grow. We still got a growing population, still growing at a pretty decent rate. We're struggling to build enough homes, and there's a lot of developments, obviously, being held up by red tape, as well as obviously increased building costs. So if we throw inflation into the equation over the last few years, now inflation was driven and is driven by rental growth as well. Like that does directly affect the housing market, as does build price increases, all these sorts of things, which if I look at even very simply at like what we were building granny flats for, say 5 years ago, which was 115, 120, 130,000, they're now at like the same product now that was maybe at 130,000 is now around about 200, 220,000 to build that same product. So you've seen around about, like, just off the top of my head, maybe like 70, 80% increase in terms of build costs over that time frame as well, which is massive. We've seen massive insurance cost increases, council cost increases, everything, right? So everything across the board has increased. So to expect our rents to then fall back to like pre-pandemic levels, it's just not going to happen. It can't happen. There's just been too much growth in all other sectors of the market. There's also been increase in wages growth pretty substantially over that time frame as well. I don't know anyone that's still being paid the same money as what what they were 5 years ago. And for a lot, I know it's actually been a very substantial increase from that perspective. The only way I believe that a market will or has potential to go into big decline is things like mining towns, which haven't really been on a big run. There has been growth in the last few years, but when you're mining towns, they go through their big boom bust cycles, and an entire population, or many people leave an area, especially higher income people. Yes, that has the potential to affect that, but that we're talking about potentially 1% of Australia there. The rest of Australia is pretty safe from those big ups and downs. But realistically, the chances of rents coming off much at all, if at all, I think are very, very slim. Even one final note on this as well is, even if we could get more red tape, cut all the rest of it, try and bring more housing we don't have enough builders, right? We don't have enough trades, we don't have enough builders to even get these things to market. The government has the policy said 240,000 homes a year for the next 5 years. We're in year 2. We're nowhere near target. Like, we do not have the builders, the capacity, and pricing just doesn't work as well to be able to bring these things to market. So it's not going to happen, guys. There's not going to be enough supply. It's a supply-demand issue always, and the imbalance is not going to come in enough of effect that we are going to see a big drop in rents. And if anything, to kind of cap out on that as well, I believe that the next few years we're still going to see rental growth, because we're still going to be in a housing shortage and a housing supply shortage over the next few years. So while rents may not grow at the same level they did over the last 2-3 years, where obviously there was a massive stock deficit from a rental perspective, but also there was that massive surge in interest rates as well. We had a 4.25% run on interest rates over an 18-month window. That obviously affected, like, a lot of people either had to cash out and get their money out because they couldn't afford to hold it, or they put rents up in line with it, or circa in line with it, to then be able to afford to retain holding that product as well. So realistically, guys, it's not going to go down in almost all areas in Australia. You may even see some continued rental growth over that time frame as well. Moving on, guys, and story number 2, housing market on the cusp of another boom. Michael Bleeby of the AFR writes, Australia's housing market is on the cusp of another boom that will push housing prices even higher than Sydney's new median of 1.65 million, when rate cuts next year give potential buyers more funds to compete for properties, data provider Domain says. House and unit prices in Sydney, Brisbane, Adelaide and Perth hit new records in September quarter as sentiment improved amongst consumers. The borrowing costs had stabilised and the next move would be down with interest rates. House and unit prices in Sydney, Brisbane, Adelaide and Perth hit new records in the September quarter as sentiment improved amongst consumers. The borrowing costs had stabilised and the next rate move would be down, Domain chief economist and research head Nicola Powell said. But even though momentum in the East Coast dominated market was now slowing, once the Reserve Bank of Australia starts cutting rates, consumer confidence and buying activity and prices would pick up again, she told the Australian Financial Review. The high cash rate is helping temper the pace of price growth. What's going to happen when we see the cash rate being cut and Australians feel more confident that inflation is now tamed? That will boost sentiment. When you get more positive sentiment, you get a greater rate of price growth. The figures and outlook from Domain show that the post-pandemic surge in borrowing costs has only dented and not fundamentally changed conditions in Australia's largely unaffordable housing market. More homes are coming on the market, with over 3,000 up for auction last week. Only the second time this year, the weekly number of auctions topped 3,000 homes. And a national preliminary clearance rate that CoreLogic said slipped to 66%, indicating a weak market. Economist Louis Christopher and New South Wales Valuer General Sally Dale both predict that housing prices in the country's largest state to turn negative by year end. The rate of gain in Australia's most buoyant housing markets generally slowed in the September quarter from June, but even with a cut in borrowing costs, Sydney's median house price rose 0.6% in the quarter. Brisbane's median house price jumped 1.5% to a new high of $995,000. Adelaide also hit a new high where it rose by 4.2% in the quarter to $973,000, which is crazy. And Perth also jumped to a new high, up 3.1% in the quarter to $894,000 as well. The central bank has not cut borrowing costs, but federal government stage 3 tax cuts that came into effect from July 1 had given the same boost to household cash flow as a 50 basis point loosening in the cash rate. The next rate cutting cycle, which is likely to start at the end of March, would further increase the sums people could borrow to spend on housing and draw back in buyers who are still holding out for a cut. We're going to see borrowing capacity improve and mortgage affordability improve, she told the Financial Review. That will bring people to market next year and will likely spark greater housing turnover. Guys, if you remember the podcast we released last year, it was around about 12 months ago, maybe a little bit over that, with Big Lukey Chusin and Big Jimmy Ibrahim as well. What we really ran through, and the episode I'm talking about there is a super boom. Now, super boom episode, everything we ran through there, specifically with 2024, has literally played out. You look at, there's plenty of markets in Australia that have done 30 to 40% plus price growth this year alone. And I strongly believe that heading into 2025 and beyond, there's going to be other markets that still produce those same numbers. Now, some markets will continue to perform in a big way. Other markets will start their cycle and then start a pretty good run. But what we're really going to see next year is we've got these stage 3 tax cuts coming in. They're going to put a bit of a boost into the economy. We're seeing inflation coming back down. The unemployment rate is still pretty tight. So the economy's still pretty strong. And then once those interest rates start coming back down, remember, the biggest thing was the supply constraints combined with the population growth. And whilst population growth has eased, supply constraints are still extremely tight. The builders aren't bringing anywhere near enough product to market, and it's only slowing from that perspective. The interest rates being cut was always the jet fuel that was going to be thrown on the fire. And even if they do them in a steady decline from some point early next year, and then maybe another in the mid, and then the end, and then maybe they keep easing them into 2026, all it's going to be doing is continually adding some affordability and servicing to everyone's bottom line when they're going out there trying to buy homes or building their property portfolios as well. So what we'll see is this continual gradual boom and continual gradual increase of servicing, which will keep flowing on to price growth. Now, it doesn't mean that it's going to, the market's just going to keep going everywhere. Like they were saying there, Sydney's coming off the boil, more and more auctions coming to market. They see that market moving into decline by the end of this year. But it does mean that there's plenty of other locations out there that will move into these growth phases. And as they become more and more affordable, more and more opportunities come around this. And then when the interest rates come in on top of that as well, what we're really going to see is that spark and that ignition around some of these other markets to finally take off. And it's also going to keep some fire under these, specifically like more affordable markets that have been on a great run. It's just going to keep more juice in the tank. It's also going to prolong the peak. While the rate of growth might slow, it might extend that peak and it might extend that run period that we might have in some of these other capitals as well, and really prolong some massive gains for people who got in really early. So guys, look, that's a bit of a recap on that, and obviously what's playing out, what it's looking like over the next couple of years as well, and really the fact that people are still talking about it now, that more and more growth is going to be coming in, more opportunities out there as well. I think it's only a good thing for obviously people being out there, investors being active in the marketplace as well. Now guys, that's a wrap for another APS Weekly News Bulletin. I hope you took some great value from the episode. If you did, please send it on to someone else that you think might also take some great value from today's episode. And until next week, guys, it's another APS Weekly News Bulletin on the Scouting Australia